All right, welcome back to The Explainer. Today we're taking a hammer to a massive beginner trap. You know the feeling, right? You think you found the absolute perfect stock in this incredible industry, but your portfolio is just bleeding red. Why? Well, it's probably because you're completely ignoring the rotation engine. So we're going to fix that right now.
Okay, let's dive into this. Here's the harsh truth. Buying the exact right sector at the totally wrong phase of the economic cycle, yeah, that can still lose you a ton of money. Think about it. Energy stocks are fantastic, right? But really only in late bull markets. If you buy them in an early bull phase instead, you're literally early by a year or more. You're just going to bleed time and capital while tech and transportation quietly do all the heavy lifting in the background.
So I want you to picture sector rotation like this giant, high-stakes relay race where the baton is capital. That capital passes from runner to runner in a highly predictable order across 5 distinct phases. You've got your early bull, middle bull, late bull, early bear, and late bear. Now, sector rotation exists because different industries just make money under fundamentally different economic conditions. So capital rotates into whichever sector benefits most from the current phase. And here's the kicker. It does this well before that phase is actually confirmed by the news headlines.
Let's actually break down the mechanism behind each handoff. It all kicks off with the early bull phase, which heavily favors technology and transportation. Why? Because these sectors anticipate the very first stirrings of growth. We're talking about new microchip orders being placed, or shipment volumes ticking up on trucks and trains, way before anyone else in the broader economy actually feels a recovery.
Then, as the cycle matures into the middle bull phase, that baton is handed straight to capital goods. Once that early growth is finally confirmed and businesses are feeling confident again, what do? Well, they start dropping heavy capital on major equipment, industrial machinery, and physical expansion.
Now, by the time we hit the late bull phase, the economy is running hot, so the baton passes to energy and basic materials. This happens because, as inflation actively rises, commodities like oil, chemicals, and metals, they step in as a natural, highly profitable hedge against all those rising costs.
But the cycle always turns, doesn't it? Entering the early bear phase, capital gets highly defensive and rotates into healthcare and consumer staples. The economic reason here is super simple. It honestly doesn't matter how bad a recession gets, people are always going to need their medicine. And they'll definitely still run out to buy groceries and, hoard toilet paper.
Finally, closing out the whole cycle is the late bear phase, where financials and utilities take the lead. Now, these are capital-intensive, debt-heavy sectors. That means they benefit most directly and immediately from the cheap money that floods the system right after the Federal Reserve inevitably cuts interest rates to stimulate the battered economy.
So, the absolutely crucial point here is this specific mental map. Seriously, lock this into your head. This transforms a vague, fuzzy feeling about the economy improving into a specific, mathematically sound, tradable sector call. It completely connects the dots between what's happening structurally and where the big money is actually flowing.
All right, quick check. Let's pause for a second. I want to challenge you to apply this mental map to a real-world macroeconomic scenario. Let's say inflation has been actively climbing for 6 months, and commodity prices across the board are surging. What phase of the cycle are you likely in, and what sector belongs on your immediate watch list? Take a second. Think about it.
Got it? You're in the late bull phase. In this kind of environment, energy and materials are your absolute best friends because they act as that necessary inflation hedge. Meanwhile, if you applied this correctly, you'd also realize that earlier cycle leaders, like, say, the tech stocks from the early bull phase, well, they might already be losing their relative strength.
And this brings us right back to a core foundational mechanism we've talked about before, the lead-lag relationship. Sector rotation happens well ahead of confirmed economic data. It acts like an early warning radar for the business cycle. Listen, if you're sitting around waiting for the official news anchors to announce a recession or an economic boom, you're trading the past, not the future. By the time it's on TV, the smart capital has already rotated.
So let's quickly recap your new superpower. You now fundamentally understand why sector rotation happens. Capital is just constantly chasing phase-specific economic benefits. You know the 5 distinct handoff phases of the relay race. And most importantly, you know exactly how to match current inflation and growth data to the right sector, well before the crowd even catches on. But I'm going to leave you with one final thought here. How do you actually execute this perfect sector call without picking a single individual stock wrong and, ruining the whole trade? because being right about the sector doesn't guarantee you'll pick the right company inside it. That is exactly what we're going to cover in part 2, where we get highly tactical with ETFs, basket trading, and real market examples. You absolutely won't want to miss it, so I'll see you in the next explainer.